right, good morning. Welcome to Forex.Today, the YouTube channel of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Can you imagine that? That being said, hey, even when you're planning, yeah, the mic was turned off again. I don't know what happened there. Well, let me start over again. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please always stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. My name is Wayne. I will be your guide on this journey we call Forex. I wish for you to become a patient, disciplined, independent thinking foreign exchange trader that looks at trading as a small business, not as a means to get rich quick. It just doesn't make sense. So that's why we plan. Think of it. Every successful business on the planet has a business plan. Well, you're a businessman. So what is your plan? What is your bias? What kind of research do you put into your work? Forex is straightforward. All you have to do is know absolutely everything about, let's say, business, economics, politics, geopolitical aspects of world trade. And then, of course, translate that into accurately predicting the future every day. Besides that, it's pretty easy. So, it seems like it's a long haul. Patience and discipline will win the game. Huh? What do investors into Forex want? If you were going to be a money manager one day, what would those investors want? To get rich quick? No, they're already rich. So instead, what is the proper business model for this thing we call Forex? How about consistent returns with low volatility over long periods of time? And so I'll try to teach you how to do that, both using fundamentals, charts, and really even the psychology of being a business and creating value. So, oh my gosh, that is a lot. So why don't you ask questions? Treat other people in the chat with dignity and respect. And we'll go through the charts. I imagine we will do gold, oil, and Bitcoin, as well as dollar pairs and yen pairs. But let me know what you want, what you need, and I will do my best to serve, because I see our relationship as one is that I'm a servant here. So let me know how I can serve, and I am happy to help. Over the 20 years of me doing this, people have asked for additional help besides these live streams. Now, there is 6,000 videos on YouTube associated with my work, probably 10,000 hours worth of videos. But you're like, Wayne, I need more. Some people asked me to write a book, so I wrote a book, Strategic and Tactical Forex Trading. I checked it out. It's still one of the highest rated Forex books of all time on Amazon anyways. Cool, right on. That's one way. What about training videos? Wayne, can you make some training videos? Yes. So at fxbootcamp.com, there are 65 hours of training videos. Some of the stuff I learned at Harvard, so you can kind of get a Harvard education for $88. $88. How much is the book? It's not my book. It was published by Wiley Publishing, so they own the rights to that book. But I believe it is 50% cheaper than it was back in the day. So that's cool. A lot of people like to read, Thomas, right? It's their modality for learning. So that resource is there. Other people like videos. So that's $88. If you want to join a live group because you prefer hand-holding or interaction, well, you can upgrade your account at FX Bootcamp. It's a little bit of money, $99 a month, for example. Not a big deal. You also probably want a trustworthy, ethical broker that offers fast execution speed, narrow spreads, good swaps, world-class customer service. I recommend TradersWay.com because they earn my loyalty and respect. Pretty simple. So if you open up a demo account with TradersWay.com, maybe they'll earn your loyalty and respect too. It's a good start. Oh, let me move this around. Oh, I can see. Whoa, let me move all this around. I'll move that over there. I'll move this over here. Let us move over here first. Let's go to Forex.Today. I still look like Rudolph the Red-Nosed Reindeer. Rudolph the Red-Nosed Reindeer. Let's change this to today is going to be the day. All right, Bank of Canada is making an interest rate decision in an hour. Not 2 hours, Darko, 1 hour. Okay, and so that's why I had this page open, this one. Pachow. So right now we have interest rates in Canada, Canada. Well, Darko, you should be. Quite frankly, I'm shocked at your behavior. Sometimes I don't know who you are anymore, Darko. Yeah, it's fine. Okay, so what's priced in? Probably interest rates going to 4%. And when the Fed raises interest rates, you'll see that the US dollar gets strong. But the United States is a reserve currency. So when Canada raises interest rates, you'll probably see weakness. So let's take a look. Pachow. Oh, look, over the last few hours, the Canadian dollar got weak. That's an index. That's an index I created. This is Canadian dollar versus everything. And so either everything is strong or the Canadian dollar is weak. So that would be the assumption of interest rates going up. Now, let's talk about what's next. We may find in their statement or in the press conference that Canada, maybe, just maybe, I'm not predicting this, but they could come out and say, hey, we raised to 4, and now we want to see what's next. Maybe we will pause. Okay? Isn't that interesting? What if they pause? What if they announce at least a slowdown? But what if they just change their tone and say, it would be prudent to maybe sit back and see how the raising all the way to 4% will impact inflation. Their inflation isn't 8%. You notice that? It's not 8%. So do they need to raise as far as the Fed? That's a question. Another question is, did the federal government of Canada issue stimulus checks to the tune of trillions of Canadian dollars? Or is something else creating the 5% inflation? So to compare and contrast to the United States, the Federal Reserve created $5 trillion in credit, and the federal government issued $5 trillion in stimulus. And a combination of those created inflation. Well, did Canada do the same? Did they do the same but to a less degree? Did they not do what the United States did? And this is a great contrast because maybe you could argue central bank activity by the Fed created 5% inflation. But we got almost 10% inflation. So what created that other 5%? Well, that would be the stimulus checks. Now, even that, I would maybe push back and say, I don't know if that's quite true. But nonetheless, what we're asking here is if the Fed has a terminal rate of 5%, does the Bank of Canada have a terminal rate of 5%, or is it 4%? So, anyways, what this means is if the Bank of Canada seems like they want to raise interest rates even more, the Canadian dollar will weaken. Because higher interest rates in Canada is bad for the Canadian dollar. Okay? If they say we're for and we want to pause because they have less inflation created by stimulus and their inflation right now is more supply chain related, then maybe 4 is their terminal rate or close to 4. You know, if they're almost done. If they announce they're almost done, then the Canadian dollar will actually strengthen. Isn't that interesting? So the Fed and the Bank of Canada are not the same, is what I'm trying to say. So if you have questions about that, let me know. I will do my best to help. Okay, let's take a look at what you're trading today and see what's going on. I'll end the poll. Thank you very much for participating in the poll. I appreciate that. We need 30 respondents to make the poll statistically relevant, and we have 60. So that's good. And it looks like you guys are spread across the board. Not very many people are trading the Canadian dollar. And I would almost ask, why not? Most likely, you didn't know about the Bank of Canada raising interest rates today. Really? How come? Okay, that's a shame. All right, so what else do I see here? Japanese yen all over the place. Continued weakness despite intervention and yield curve control. Dollar has gone from strong to weak, which is related to seasonality. If you look at the 5-year average and the 20-year average, that is also normal. As I've taught you many months ago, in fact, going all the way back to January, I prepared you for dollar weakness going into November elections. Now, seasonality will tell you, around September, over the last 5 and 20 years, the dollar gets weak in September. Sometimes even August. But in January, I said, not this year, because we're in the second year of a 4-year political cycle in the United States. And if you drill down into seasonality more specifically, again, looking at the political cycle, not just annual, but political, what I said is the dollar wouldn't weaken until the end of October. Not end of August, not end of September, end of October, which is my alpha. And it seems to be about right this year. So, hey, congratulations. Doesn't mean our financial troubles are over, but it is a change. Raymond Scott taken out of his weekly swing. Yeah. Frank says, I mentioned this 3 months back, but 3 months back, 6 months back, and even 9 months back, Frank. But thank you for the confirmation. I appreciate that. It helps drill home my point that these things are not magic. It's not your fault if you didn't know, but now you know. Okay, so you guys some are looking at Euro, some are looking at Aussie, some are looking at CAD, some are looking at Pound. Oh, okay. Let's take a look at the weak US dollar. And then after dollar, maybe we'll do yens. And then after yens, maybe we will do gold, oil, and Bitcoin. Is that okay? Okay, we'll just start with Aussie. And going back to Sunday and Monday, we had identified this price in here, which I have, highlighted with right here. I said, look, that's technically important as a price level. And if bearishness will continue, it will look like this. But I said, because of the time of year and such, and then you can see I have this, right, that we have a lot of legitimate support. And if we breach this level, that's where, if you're a bear on this pair long term, you go neutral, technically. And that's where we are now. So a bear could get caught here and say, well, this is the plan for next week, which technically makes sense. But I'd be careful. I'd be careful. This seasonality is pretty legitimate. I wouldn't be shocked if we go all the way up to 67 and then maybe work our way back around. Or this just keeps going up and up and up until the second week of December. Okay, and that's what I talked about January, that dollar might just weaken just before and just after the election. The election is the 8th of November. It's a Tuesday. Anything else going on around that period of time? Yes, the Wednesday before the Tuesday, so I believe it's the 2nd, we have the Federal Reserve Bank of the United States issuing their interest rate decision and press conference. Okay, where I think we could go higher than even 5.25. So we will find out more. Why do I think maybe 5.25? Bear in mind that's not priced in right now. Well, I don't believe our inflation is caused by low interest rates. Okay. Our inflation is caused by a supply chain problem and too much money in the economy printed by the federal government. Remember, when somebody says it's the fault of the Fed for printing money, you have to correct them and say, excuse me, but the Fed doesn't print money. The Fed issues credit to commercial banks. And banks don't give money away for free, do they? Have you ever known a bank to give away money for free? No. They solve the asymmetric problem, right? The asymmetric information problem, and try to find worthy projects to deploy the capital towards. Maybe you want to buy a house. That's an asset. They can lend you some money if you have some collateral. Plus, they can take the house away if you don't pay. They can lend it to a small business so they can buy inventory. Or maybe to another small business to expand their business. And for all of that, there is two things: productivity for the economy and a return on investment for the bankers. And they don't have a printing press. the Federal Reserve Bank of the United States does not have a printing press. The United States Treasury has a printing press. And so that's where I believe the inflation comes from. Because when you give somebody money for free, there's no productivity. No return on investment. That's where you get inflation. Big difference between credit that you can put toward a productive project versus just money for free. The number one use of federal stimulus has been hospitality, food, and beverage. So that beer you bought with your Joe Biden money was not very productive for the economy. And now we have inflation. So anyways, interesting world we live in. So we'll see what happens on the 2nd and then the 8th, and then somewhere out around the 15th of the month, we have CPI. So we got a few weeks of very important information coming our way. Frank said, would raising taxes reduce inflation? It's the only way to do it, Frank, but there's only one way. Raising taxes in of itself isn't enough. So you have to go back to like Milton Friedman, for example. Milton Friedman said, the only way to create inflation is by printing money. And this would be backed by more modern experiences that maybe you and I have had, because Milton Friedman was a while ago. In 2008, the Federal Reserve Bank initiated quantitative easing and issued more credit and liquidity into the market than ever before. And we had no inflation. Then we got COVID, and the federal government printed money and gave it away for free, and we have out of control inflation. Okay? So that makes sense. So I would argue that that would prove Milton Friedman's theory of the to be true, because here's the interesting thing about money. Okay? Let's clear this chart here. Here's the interesting thing about money. We'll go this way. Okay? When you have money, where did you get your money? From income. Where did you get your income? From work. Your work is productive. You got paid for your productivity. So now you have money in your pocket and you go to Supercuts and you get a haircut and you spend some of your money. Okay? Your spending now is income for Supercuts. Supercuts, I think, is a publicly traded company. So anyways, the owner of the Supercuts gets some money. The landlord that owns, the space, the real estate, they get rent. The power company gets money. The insurance company gets money. The stockholders might receive a dividend. And the woman who cut your hair receives her income. And then she goes around the corner and she goes to Applebee's and buys lunch and spends that money. Now, the cook gets money, the busboy gets money, the waitress gets money, the landlord gets money, the insurance company gets money, the power company gets money, the owners, like shareholders, might get dividends or distributions, and they get money. That just comes, a little bit of it comes from the Supercuts lady, okay? And then somehow this gets to you at work, and then now you have your money. So we call this the velocity of money. How often does $1 turn over? And it shows income. But the thing is, there won't be inflation no matter how fast this occurs, because there's a finite amount of money. So when you're talking about money in economics, okay, you can talk about the demand for money. This is the demand for money. This is the quantity, and this is the value of money, okay? But the supply curve is vertical. The reason for it is there's only that much amount of money. Demand might change, but there's an exact, precise number of how much money there is. So the money can go around, and that's just shifting your demand curve up or down. Low demand, low velocity, low value. High demand, high value. Because if there's high velocity and this is going around, well, the value goes up and up and up because there's so much demand to get a dollar that the value of the dollar goes up inside this domestic closed economy. And there will never be inflation. There'll just value will go up, but never inflation. You cannot create inflation. You can only raise and lower the value. And you're like, isn't that inflation? No, not really. It might look like it. You might say high demand, low inflation. Yes and no. They look similar, but they are quite different, especially the outcome for the economy. So the only way to create inflation is to give everybody a whole bunch of money. And you increase the supply from supply 1 to supply 2, and it lowers the value in a different way. But the problem is you can't take it back. Now, I'm going back to Frank's question. The only way to take it back, okay, is not through removing credit from the market, like a bank could do it, okay? But instead, the only way to kill inflation, according to Milton Friedman, is that you raise taxes, because this money came from the federal government. If it came from the Fed, they would just do quantitative tightening and remove the money that way. And the Fed does this all day, every day, through their dealing desk. They either add money to the market or they remove money from the market. And from that, they get an interest rate. That's what they do. It's called open market operations, OMO. That's what the Fed do. Okay? But instead, since this came from the federal government, not from the federal bank, the federal government could raise taxes, and if 100% of that new income goes to paying down the debt, then that would remove the money. You can't raise taxes and then redistribute it. No, because then you still have the debt. No. The only way, okay, to reduce inflation in the United States is really raise taxes, take 100% of that income, and pay down the debt. And you can read Milton Friedman, and this is what he was talking about back in the day. Back in the day. So here we are reliving history. And it's amazing the mistakes that the government's made, but it's a tough choice. It's a tough choice when you have a global pandemic and people are dying in the streets. The government will always print money. Okay? They will always do it. because it's a tough choice. You're like, we want to help people, but we ain't got no money. Well, you can print it, and it solves the short-term problem, but creates very, very destructive long-term problems. And that's just economics. And it's not just the pandemic. It's happened over and over and over and over again over many, many hundreds of years. It's nothing new. Okay. Okay. It's nothing new, and it is solvable. I just solved it, Frank, by explaining that. All the government has to do is raise taxes and pay down their debt. What do you think the chances are they're going to do it? So I didn't read much Milton Friedman at Harvard, but I took a class. My professor used to work at the New York Federal Reserve Bank, right? The New York Fed. And she ran a class on universal basic income. And so if you're going to read that, you will definitely read some Milton Friedman, because that was one, sort of idea. It wasn't a solution, but it was an idea. And so through that, I've read some Milton Friedman, and then through the papers I wrote, I had to do research, and I pulled up Milton Friedman quite a bit, because again, that was the topic. I also took another class from that same professor on what was it actually called? Social welfare? Minimum wage? Maybe it was minimum wage. I think it was minimum wage. So she did a class on minimum wage, or roughly about that, whatever the title was. And the other one she ran was on UBI. But it was fascinating because A, she used to work at the New York Fed, but B, these classes were set up for debate. So we would learn about the subjects, we would get lectures, we would write papers, but in the end, it ended up being a debate, because there were unanswered questions. It's not like math where you do the math and it spits out an integer at the end. You're like, that must be the answer. It's a choice. So it was very, very interesting to take those classes. Okay. All right. So yesterday in the day trading group, we were talking about parity. And I said, I don't care about parity, but what I care about is 104. And here we are at parity right now. Be very interesting if we're on our way to 104. Currently, the projected high for November is approximately 103. Okay, 104 is way, how did I get to 104? I don't even remember. Okay. But once again, if you were a bear on this, it's no longer a good opportunity to be a bear. Okay. Okay. So anywho, be careful. Watch your longer term, like for example, the fair market value for Great British Pound is approximately 122 today, but over time will probably drop to 120, maybe even a little bit less. But we're only at 115. Okay, I'm just keeping my eye on the time because of the Bank of Canada. All right, let's do gold, oil, and Bitcoin. Hoorah! Should we start with Natty? No. All right, let's start with gold. Gold. Okay. Is there an increase in demand for gold? I don't know. But if you believe the dollar is going to weaken for some time, then you can convert your dollars into gold. You might have been buying dollars over the last several months during dollar strength. But right now, central banks, the People's Bank of China, the Bank of Japan, as examples. Okay, maybe even the Bank of England. They are selling dollars right now. So one thing they could do is sell their dollars to buy gold. Now, I don't think that's the mechanism that they're doing right now. They're selling dollars to buy their own currency. The Bank of England is selling dollars to buy Great British Pound. The Bank of Japan is selling dollars to buy Japanese yen. But nonetheless, if the value of if the purchasing power of the dollar is diminishing, then gold is just gold. Remember, gold has never changed, ever. An ounce of gold 1,000 years ago would still be an ounce of gold today. Gold has never changed. So what does change? Well, the value of everything else. An ounce is an ounce. It always has been an ounce and it always will be an ounce. How much does it buy? Well, that's what changes. So again, just in of itself, even if demand does not increase for gold, if the dollar is weakening, the price will go up. Now, I'm looking at longer-term moving averages here, and it says, well, this is still very much bearish. So be careful if you're a bull. Because now that we're up here, there's a lot of selling pressure. Okay? So if I were to ask the charts to tell me where this should go, not where it will, but technical analysis of this would say we are going to S1 for November. And that price is 1610. Now, we could extrapolate from that and actually take it down below 1600. Okay? And it would look like this kind of plan. Well, actually, let me redraw this. There's two things I see here, actually. We hold here, and then we drop down. I'll just make it nice and easy, like 1550. The other thing I see for bears is it goes higher. And because of that, we only make it to S1 and then we stop. Now you say, well, why not M1? Well, it has to do with the moving averages, not the pivot point. It might go to M1, but let's just be the more conservative and say that would be sort of the next. Both are assumptions that your bias is bearish, which means the value of gold goes down or the US dollar goes up. Okay. So again, I'm just looking at the moving averages. They don't say up. Now, you could trade against that. Of course you could. I don't like to personally, but I would understand why you're doing it. In particular, on smaller time frames, you're going to be looking like up, 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 down, down, buy. 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 Up, 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 up. Okay? That might be your plan, and it's not wrong. Just, I don't want to do it. Okay? Your bias might be up, and that would be great. I would wait for these moving averages to roll over. Okay? Because if I thought it was a long-term move, eventually we would get a higher high, higher low, higher high. So I can do that later. It's okay. I'm not in a rush. And I'm certainly not going to bet against the trend. So I can't control what the market is doing. There's no right or wrong. The market is what the market is. So it's just factual. So I can look at it and say, well, I can't know for sure if it's going to do that. Okay? I can't control the market, but I can control my behavior. So I make a decision. Do I want to trade against those moving averages? I could. But I'm choosing not to. So, for example, I might have a plan that says maybe around 1700 I look for a short. Kyle says, so you say not to let the chart set your bias. My chart does not set my bias. Okay? Charts only tell me entries and exits. So let's contrast this for a second on bearishness. Do I have to be bearish here? No. Could I be bearish on the lower high? Yes, but it's still tricky. Okay? What about after this lower low? Well, then I can sell the lower high and the moving averages, and that's easy. Done. So I think the safest trade is here. Now, could I guess here? Yes, especially if I had a fundamental reason for it. What about this one up here? Well, how would I know that that was going to happen? Oh, great question here. What sets your bias? Fundamentals. Macroeconomics. What do you think of that answer? Okay. For example, let's go back into history. For those that are newer to our community, we'll jump back into the time machine. I'll rewind the tape a little bit. Okay. So we go all the way back into this period. We get a lot of volatility around COVID. Economies around the world are closing. Okay? And that's immediate demand destruction. And when you study economics, one of the things you study is something called aggregate demand. Okay? And when economies around the world close, it kills demand and then price immediately falls. But I'll take India as an example. India had a problem. Because they shut their economy down, there was no way to make money in the economy. Everyone was locked in their apartments. But this creates demand for money. Remember that money demand? Okay, demand is here. And the supply of money is vertical. Okay, so what happened is demand for money went up because people were bringing money home from investments overseas, like the United States. So the curve shifts, and you'll see the price. This is the value, if you will. The value of the Indian rupee skyrocketed from value 1 to value 2. Okay, so the rupee got really strong. Now this causes a problem because not every central bank or not every economy wants a strong currency. If you're an exporting nation like India, you actually want a weak currency to compete with countries like China. So money going back. Okay, so imagine you're an Indian family. You can't work. You need money to buy food and all that kind of stuff, but you have no means to work, but you have money invested in the United States stock market. Suddenly, you sell whatever asset you had. So you sell your stocks in the American stock market. Stock market falls. The S&P 500 falls, which it did. And the money goes back to India, so they sell the US dollar, and the dollar did weaken. And they buy their Indian rupee because that's what they need to buy food in India. So now the rupee goes up in value, which causes other problems in India. So the central bank decides, you ready for this? The central bank says we need to weaken the rupee. How do we do it? So you got a balance sheet. Okay? This is the liability side. This is the asset side. And so let's say there's two assets they have. Cash. Okay? And they have gold. Let's say that's all they have on the asset side. And they wish to lower the value of the rupee. But they also want to keep their balance sheet balanced. Hey, you enjoying this? Make sure you click the thumbs up button. Come on now. Kick down, come clean. Don't be a holdout machine. Click that thumbs up. So what India did was they took their cash and they bought, let's say, a billion, okay? They took $1 billion in rupee, whatever, 100 billion, whatever. And they exchanged their cash for gold. So they have 1 billion rupees more in gold and 1 billion less in cash. So now the balance sheet is still balanced. Nothing happened at the Reserve Bank of India. However, in the foreign exchange market globally, okay, again, value, quantity, demand for rupee globally. Now this is global market, global, not local market, global market, what we call the interbanking system. And what the Reserve Bank of India did was move, remember it's vertical because there's just that much, and they shifted the quantity from Q1, okay, to Q2. Okay? So they increased the quantity because, remember, the Reserve Bank in India went into the global market to buy gold. They gave up their rupee and bought gold. So now that rupee is in the market, there's more rupees than there were before. And now the value went from value 1 to value 2 because now there's more rupees in the world. And they devalued their currency, but maintained their balance sheet. Okay? So, guess what happened here? By the way, I was doing this in real time as this was happening. This is not me learning something at school and coming back and sharing what a professor explained to me. I was doing this in real time as this was happening. I was explaining why it was happening. Okay? So, during this period, the Reserve Bank of India increased their supplies of gold on their balance sheet to the highest in the history of the bank. But also Israel was doing it as well, and many, many other countries, particularly exporting countries. So when things flip and inflation is a problem, what does the central bank do? They sell their gold and they buy their currency, lowering the value of gold, increasing the value of their currency, which is deflationary. Selling gold brings inflation down. Because now your currency buys more than it used to because it's stronger. Remember, if gold goes down, the currency goes up. So now your currency buys more than it used to. That is deflationary. And you're like, well, but I'm like, yes, I know. I explained that back in 2020. That at some point, the central banks will want to sell because a weak currency helps you competitively, but it will cause inflation from lower purchasing power. And then all of a sudden, when the economies want to reopen, if inflation's a problem, they'll just, one way to deal with inflation is sell that gold and buy your currency back. Right now, we have central banks selling their dollars and buying their currency, which is deflationary. And you're like, well, but yeah, that's how the world works. And so when somebody says, well, how do you set your bias? That, my friend, sets my bias. I want to understand why the world is behaving the way it is. The rest is technical analysis. At what price and time do I enter my trade? At what price and time do I exit my trade? But it certainly doesn't answer why I made my trade. Isn't that nice? We call that macroeconomics. Is it possible to portray your technical edge to a hedge fund or investment bank, and if they're impressed, use it? No. If you can trade, yeah, they'll hire you. If you've developed an algorithm, yeah, you could sell it. But what you're asking is like, usually, let's say maybe you're different, but it's usually like someone going to a venture capitalist with no business plan, no product, but they have this idea and they want to get rich. You won't even get in the front door of a venture capitalist unless he happens to be your uncle. And even then, there's about 5 levels of VCs that you need to talk to before you talk to the guy you're talking to. So, like, I was a venture capitalist in the Silicon Valley and a high-tech entrepreneur in the Silicon Valley for many, many years. And there are layers upon layers upon layers, okay, of how the industry works. And you need to play everything perfectly right along the way. Talk to the right people at the right time and have the right level of development in your company and have set your company up just right and taken money from just the right people, right? Your cap sheet has to be clean. The structure of your company has to be well. You have to have the right lawyers, the right accountants, the right advisors, the right angels, and then the right, Series A, who can introduce you to the proper Series B, who can get you to the C and mezzanine levels. And you need to know, okay? You need to know the game and not just have a really good idea. Do really good ideas get funded? If you know how to play the game. All right, so let's go to Bank of Canada. How lovely. Lovely. Let's take a look here. Let's go to a smaller time frame. Let's do 1 hour. Okay. And let's see what changes here. Let's go back to the BOC. Where's my BOC? Bank of Canada. Okay, they did not raise interest rates by 3/4 of a basis point. Okay, now look for the word prudent. Okay, you should probably read the report. Okay. Should probably read the report. Let me get the link for you. Because I love you. You're my sweet baby. I want to take care of you and make sure you're safe. Hey, good morning, Adam. It's a cool morning here. What's the temperature there? So read the report. Participate in the press conference, maybe. Look how old school that is. It's so Canada, huh? 3 3/4. The effects of recent policy rate increases by the bank are becoming evident. Housing activity has retreated sharply. Spending by households and businesses is softening. Okay, oil prices are down. Economic growth is expected to stall. The bank projects GDP to be 1% next year, under 1% next year. Governing Council expects the policy interest rate will need to rise further. Okay. Yeah, QT is raising yields, not just interest rates. So they're going to continue with that. Cool. So that's interesting. $65. Oh, wait, a different atom. I'm like, 65 Celsius? Yeah, there you go. 30 Celsius. Okay. Hey, that ain't bad. That's what, about 85? All right, so we got some work to do, guys. Y'all, all y'all. On the process of automating a trading system, how would one avoid coders not stealing the system other than an NDA? I don't know if you could. You're going to have to get used to sharing, maybe. Okay, or learn Python yourself. So let's go back and just show, let's take a longer term look, and then I'll leave you to your job. Canadian dollar is weakening. It might not last, so be careful. But they are saying they expect to raise interest rates more. So they're stepping down, right, their rate in which they raise interest rates. US dollars at a key level, if you're looking at it through an index. Yen is continuing to weaken. So get ready, maybe what, another round of intervention coming? Well, watch those price levels. But a weak yen, a weak dollar, and a weak Swiss franc is a risk on. Okay, that's a risk on sentiment. Wuhan is going into shutdown. So I'd be cautious of Aussie right now and Kiwi. CAD is unfavorable in the moment, although that might change today. Just be careful with the CAD. So that doesn't leave much except the European currencies, right? The pound and the euro. So be cautious, be patient. And I will now bid you adieu. Thank you for the hour of your life today. I appreciate it. I hope it was worth the investment of your time, because I know your time is valuable. So no rah-rah speeches, no go, 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 trade, trade, trade. But I hope I added value through knowledge and maybe a little bit of entertainment. Now you got work to do. So go do it. And for crying out loud, do it right. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. Trade safe. Cheers. Pachow. Hey, that just happened.